So Gustavo, which are the best strategies approaching earnings, calendar or diagonal spreads? Is it a good idea to do debit spreads on put and call at the same time? Okay. Now, I don't have calendar spreads here, do I? No, that's okay. My straight answer is I don't think calendar call spreads or calendar put spreads are necessarily a good trade for earnings. Why do I think that? Well, let's take a look here. Oh, sorry. Long straddle's already there. Let me add long triangle in that case. Okay. A calendar call spread, done one of two ways, Gustavo, of course, but a calendar call spread, essentially we're buying a farther out call and selling a near-term call against it. The idea of this being used as an earnings play is, let's say that we have earnings coming up next week, okay? Let's say July 1st, for example, July 1. We have earnings coming up on a stock. And I look at a potential spread where I might be able to buy a September call, which isn't going to be affected by the July 1 earnings, but I'm going to look to sell maybe a July 2nd or maybe, let's say, a July 9th call against it. The idea that is behind this is a rational one, and it's one that I look for when I do calendar spreads myself, not around earnings personally. But what I'm considering here is that the implied volatility on the July 2nd or July 9th options are going to be extremely high because they're going to be massively affected by the outcome of this July 1st earnings. The Septembers are not. They might see a little bit of increase in implied volatility percentage-wise, but not nearly as much as the July. So the idea being that I can get a good September call on a stock that I'm bullish on and have a high IV ratio. IV of the sell option divided by the IV of the long option. And the idea is that I'm selling into this higher IV that's going to be affected by earnings. So when I get that volatility crush, I've knocked down a large portion of the cost of this particular September position, and then I can continue to trade against it or get out of the position. Why do I say it's not necessarily a good approach for earnings? And the reason why is because look at the profit and loss chart. If I have a stock trading at 50 and I'm expecting a swing one direction or the other, I'd use a calendar put for bearish, obviously. But if I'm expecting a bullish move upwards, I have a capped gain on the calendar spread that trails off from the peak. And you could say, okay, Mike, well, you wouldn't be selling the 50 at the money strike. You might be selling the 60 or the 65. So you have more room for that to move up here. Okay, but even with increased volatility, 1 to 2 weeks to go, this might only be 40 cents at the 60 strike, 10 cents at the 65, and I'm still paying maybe $4 or so for the September option. Yes, I have this promise of growth if it does go up that high, but it still has a capped portion, and I didn't collect, even with high implied volatility, necessarily a lot of premium to counter the cost of what I'm buying into. Let's take a quick look here and see if we can find a good calendar call against a stock that has earnings coming up between now and expiration. So I'm going to go directly into the search tool. Oh, I don't have a search for earnings, Gustavo set up. What I want to do here is I'm going to clear everything out. And I think I am going to look for July 9th expiration. So we're going to go 2 to 20 days out, maybe 18 days out in time. And I like that idea of going maybe 75 to 100 days out in time on my long. We're absolutely going to look for a high implied volatility ratio, as I mentioned. I'm going to try to set it to at least 1.4. So that means that the implied volatility of my sell option is going to be at least 40% higher than the buy. Now, I'm going to go just 2 to 3 strikes in the money for the long, not too deep in the money. And we're going to go just 0 to, we'll go up as high as 3 strikes out of the money, just for a sample to have some things in there. And I'm going to want to see some option volume and basic open interest. This is not really a setting of recommendation. What I'm doing here is just trying to narrow down some of the results that might come in. Now, with any calendar, in this case, I'm probably going to look at least for a delta ratio of 1.6. And I'm going to leave my favorite filter off for right now to possibly illustrate something. That's the debit to strike difference ratio. I always look for a debit to strike difference ratio of less than 1, which means the cost into my calendar spread is less than the difference in the strike prices. So if I do have a large jump and I get assigned early on that sold call in this calendar spread, then in that case, I only get the max back if my broker exercises the long to deliver the short. I miss the time value on my long option, so I'm still at a profit. That's why I look for that filter. And we're going to go into fundamentals, stock price irrelevant. I want an earnings date between now and expiration. Let's just run it, see what we get. I don't want to filter it too much. There we go. How about that, Micron? While I'm here, what are we looking at? Oh, I'm looking at July 2nd, okay, to September. It's about what I said in the beginning there. We're going to add in a column here very quickly. I want the earnings date to show up. Even though this is the only one that has it, let's look for that earnings date in that case. All right. So 6/30 is our earnings date, okay? And in here, we have this situation where we're looking at this position here. 7 days away, next Friday, July 2nd, 83.5 strikes, stock's at 82.03. And yeah, we'll use the 77.50 for a debit of 629. Aha, okay, it almost came out. Applied volatility ratio is 1.49. Okay, so that means that the applied volatility that's near option, we're selling the 83.50 out of the money for $1.71 and paying $8.15 for a slightly in the money position here as well. Now, let's go to the profit and loss chart. Here we have a position where, of course, we could have severe losses to the downside if the stock falls, and we could realize some upside of 41% return if and only if the stock's trading right at 83.50 at expiration. And beyond that, it trails off, and it actually has an upper break even at 102.60. Why? Because that net debit is just slightly higher than the difference in strike. Okay, it's just slightly higher. We're at $6 between the 83.50 and the 77.50, and the debit's 6.28. So that's why we go into a loss of potentially 28 cents if the stock really ramps up. Now, if I'm expecting an earnings play and I'm going in for this high implied volatility to get the most premium in this case, where's the problem? Well, the problem is I'm probably expecting that that's going to jump more if it has positive earnings, maybe up to 90. It doesn't look like a real good return and a real good structure by itself to do around earnings. If I'm expecting a large move of 10, 12% one direction or the other, even though I'm going to experience an implied volatility crush, I'm probably looking at a long straddle or a long strangle, buying a straddle position or buying a strangle position. Some might consider an iron condor or a double diagonal to take advantage of the increased implied volatility. Well, I'm going to show a double diagonal very quickly with the same expirations. So what a double diagonal is, I'm going to do the same thing, but we're going to use the puts. So I'm going to do a calendar put spread and a calendar call spread to try to take advantage of the movement and the increased implied volatility in this case. And I'm going to try to structure it so that I have a wide upper to lower break even. That's still not that wide, is it? The upper break even's at 88.52 now, and the bottom break even 77.76. If this stock, if Micron moves 10% one direction or the other, I'm at a loss. I didn't go far enough away. Iron Condor would look like a similar structure, but it's using a credit spread, a bull put credit spread, and a bear call credit spread to create a similar position. But you know, your table profit and loss chart. So I do a bull put spread and a bear call spread. And then my hope would be that the stock did not move enough to breach the short put or the short call strike price. I'm trying to take advantage of increased premiums because the increased implied volatility around earnings. Now, a moment ago, I had mentioned that I wouldn't necessarily do a calendar spread by itself. But if you already own the stock and you're looking to do a hedge or take double advantage around earnings, it's a possibility, but what's the problem? You still have the debit. So if you're wrong and the stock falls, you're increasing your risk because now you're losing on your stock and you're losing on the long haul position you just paid $6 for. I'm sorry, $800 for in this case. Does it leave the upside open? Yes. Does it really bring in a lot of premium? Well, 179, but you're still adding to the loss if you're wrong and the earnings go the other way. If I have a stock that, let's say, has a lower cost basis, let's say I've been selling calls against it or I bought it at a lower price, I'm currently trading around $79, and I've got earnings coming up very soon. If I own the stock, my play for an earnings position is going to likely be converted to a married put position. I typically would go at least 150 days out in time, but if you just want to cover it through the earnings, don't go to the next expiration, the one closest, I should say, to the earnings event, because that's drastically going to increase the price because these are the ones that are most inflated. August looks like a good option, perhaps. And let's see, at a cost basis there, you can go cheap, but yeah, I want to add something to this. So I'm going to go with a 77.5 put, even though it's expensive. We're just going to buy one against my 100 shares of stock at 79. Now, what have I done? I've created a position that leaves the upside open in this case, and I've controlled the risk if the stock falls 10, 12, 15% from an unexpectedly poor earnings. I can't lose more than 5%. And if the stock did fall $8.20 and it fell down to, 74, for example, or 73.80, 73.50, let's call it. Well, sure, I'm going to have a loss of close to the max here, 5% on the position, $369 or so. I might even experience some volatility crush, but what I can do now is sell to close that put, because that 77.50 put I bought is at least going to be worth $4 if the stock's at 77.50. So that's going to lower my cost basis back down to 77, and I continue to gauge the direction I want for the stock now after the earnings event, maybe sell some premium against it. And if it shoots up, did I lose that 263? Is that put going to go to zero at some point? Might not lose all of it right away, Gustavo. But again, I'm entering earnings how I want, with the potential for upside, leaving the upside open in that case. And at the same time, controlling the downside risk. I'm paying a premium for it, but that's so if the stock fell 10%, I'm not down 8, 9% based on my cost basis. Most I can lose is 5. If you have a large enough gain, if my cost basis on this position was only 73, been trading it for a few months perhaps and lowered the cost basis down, had a rise in the stock, you can actually go into earnings having no risk, what we call a bulletproof position to the downside, and still the potential for unlimited upside if the stock shoots up as you expect. That's the play I would go if I own stock, Gustavo, in that case. Okay. Now, if you wanted to take advantage of both directions, you own the stock. You want to protect it going into earnings. You have a lower cost basis. You could just buy the put. But if you're expecting that you don't know which direction the stock's going to go, it could go up or down, and you want to simulate that V profit and loss chart that you get with a long straddle, buying a call and buying a put at the same strike price, buy 2 puts. Buy twice as many as the shares you own. This will be an additional cost, of course, but you may end up in a position that is almost essentially no risk. Yeah, this is a lower strike than I need. If I'm doing this, I'm doing it closer to at the money, even though it's more expensive, because I'm expecting a move one direction or the other. And in this fashion, we can profit potentially in both directions of the trade with only having a small risk if it falls right to 77.50 on the position. Now, if you want to see which puts might work best for you, if you're heading into earnings right now, I've got to add that back in, I'm sorry. Actually, no, let's go signature tools. If you have a stock that has an unrealized gain in it, and you're coming up to earnings, and you want to see which put might best protect your position, either under the Married Put tab or under the Signature Tools tab, click on Insurance and simply just put in your stock basis, put in your cost per share, and select an expiration. So I said August, but you can go further out as well. And this is showing you all the puts right now for August expiration. And instead of showing you a risk, it's showing you the percentage of locked-in profit, of guaranteed profit you had, even if the stock collapsed below these put strike prices, while still leaving the upside open. So if I did right at the money, sort of the 82 strike here, I have a locked-in profit of 5.7%. And we go to the profit and loss chart, and we can see what we're looking at specifically, where I own 100 shares of stock at $73.50. We're purchasing an at the money 82 August strike for $405, pretty expensive. That gives me a cost basis now of $77.55, but I'm guaranteed to get $82 back, so I have a locked-in profit of $455 with still the potential for unlimited upside going forward. And again, Gustavo, if you want to simulate the V profit and loss chart you get with a straddle, you just do 2 at a time, or twice as many of the shares you own. That gives you the V profit and loss chart on your position. And this one works out to be where it's no risk on the trade, where even if it fell right, it stayed at 82. There's no movement between now and the earnings date, and the earnings didn't budge the stock at all. Well, we still have a small profit of $40, roughly in the worst case scenario. But if it moves 5 or 10% up, we'll start to see profit. Will it be less than just doing nothing if the stock moves up 7%? Yes, because we're going to lose money on the puts as the stock moves up. But we put ourselves in a position with that V profit and loss chart you mentioned, Gustavo, simulating a long straddle position, but having gain already in the underlying security. We may now have a very low risk or no risk sort of synthetic straddle on a stock position. And that's how I would approach it. Not doing a calendar spread on top of the stock or even the double diagonal on top of the stock. I would do it in the fashion with the puts, even though they cost money and may experience some implied volatility crush after the earnings in that case. Hopefully that was useful to you, Gustavo, and while we would approach using that for earnings when we're stock position, if it wasn't already protected by a put option, of course, if I'm already in a married put position, following the rules in the blueprint and the radioactive trading techniques, I would use maybe an income method number 3, one of the 12 income methods that's discussed prior to earnings, or perhaps an income method number 12. And we'll talk about that at another time down the road.